Investing in dividend stocks is a great way to earn passive income. Receiving your dividend paychecks and seeing them grow over the years is an amazing feeling, which a lot of investors are after. There are still many companies out there that have increased their dividends by a great amount in the past years and might continue doing so. Today we'll be looking at some of these companies and figure out if these stocks can provide good future dividend growth. Be sure to stick around for the last stock that we're talking about today, because this is a relatively unknown company that has grown their dividend by an average of 86% in the past 5 years and is growing their top line and bottom line revenue by over 40% every year. The first high growth dividend stock of today is Williams-Sonoma. Williams-Sonoma is a retail company that specializes in high quality kitchenware, home furnishings and gourmet food products. The company offers a wide range of products including cookware, bakeware, kitchen appliances, furniture, bedding and home decor items. Williams-Sonoma is known for its emphasis on functionality, style, and craftsmanship, catering to the individuals who value well-designed and durable items for their homes. Additionally, the company operates various sub-brands and has a strong online presence, making its products accessible to a global customer base through e-commerce. Year to date, the stock is up by almost 17%, and over the past 5 years, the stock has seen a significant gain of 123%, which means it significantly outperformed the S&P 500. The company currently has a dividend yield of 2.7%, which they have grown a lot in the past 5 years, with an average growth rate sitting at over 15%. While they have increased their dividends nicely, their payout ratio is only around 20%, which means that there still is quite a bit of room left for them to increase their dividends further. In addition to this, Williams-Sonoma has also increased their dividends for 16 consecutive years now. They're currently trading at a very low PE ratio, it only being 8.47, which is quite a bit lower compared to the sector median sitting at 13.47. They are also very profitable, with a net income margin that's 12%, which is quite a bit higher than the 4% sector median. Let's check out the next company on our list. The second company we'll be talking about today is ASML. ASML is a Dutch company that specializes in the design, manufacturing and supply of photolithography machines used in the semiconductor manufacturing process. Photolithography is a crucial step in creating integrated circuits, or microchips. ASML's machines are utilized to project patterns of light onto silicon wafers coated with photosensitive materials, enabling the precise etching and deposition of various materials to form the intricate structures that make up modern microchips. ASML's technology plays a pivotal role in advancing semiconductor capabilities, allowing for the creation of smaller, more powerful and energy-efficient electronic devices, with them having a monopoly in the most advanced photolithography machines available. The largest Dutch company has seen a very nice increase in its share price this year, with the stock being up almost 20% year to date. And the stock has been absolutely crushing it on the long term, with the stock being up by over 230% in the past 5 years. The current yield of ASML is not incredibly high, which is something that we'll be seeing more often in this video, but of course we're talking about high dividend growers in this video. Talking about their dividend growth, the rate that ASML has been growing their dividends at is very solid, with an average of just under 30% in the past 5 years. Keep in mind though that the dividend payments are done in euros and are converted to dollars if you hold them on the Nasdaq listing. This means that the dividend payments will also be dependent on the current exchange rate of the euro against the dollar. And in addition to this, in the Netherlands, companies pay an interim dividend and a closing dividend, and only since recently ASML has converted to paying dividends every quarter, so that means their dividend history chart might look odd and also explains the 0 years of dividend growth rate. The dividend safety is looking nice, as only 30% of their net income is used to cover their dividend payments, meaning that there's still more room for growth. And speaking about growth, ASML is a company known for its very consistent growth. All of their income metrics are way outperforming peers, with revenue growth being almost 35%, EBITDA growth sitting at just under 25%, and EBIT growth being just below 30%. Of course, for this growth you are also paying a higher price, with a PE ratio of 32. ASML is quite a bit more expensive than its peers, and most other valuation metrics are not looking much better, which is what you would expect with a company having such a solid, consistent and important track record. The next company on today's list is Microsoft. Microsoft is a multinational technology company that develops, licenses and supports a wide range of software, hardware and services. Founded by Bill Gates and Paul Allen in 1975, Microsoft is of course best known for its operating system Windows, which is used on a majority of personal computers worldwide. As we all know, Microsoft has been on a crazy surge this year. The stock has hit a new all-time high in 2023 and is up 35% year to date. In the past 5 years, they have also been crushing it, with their stock being up over 200%. The starting dividend yield of Microsoft isn't very special, but keep in mind that this is partially due to the price being near all-time highs. In trade of this lower dividend yield, you do get a solid growth record in their dividend, with their 5-year average growth rate sitting at just over 10%. Not bad for a stock that has also appreciated a lot in price. Microsoft has also been increasing their dividends for 18 consecutive years now, and with a payout ratio of only 27.7, there's still plenty of room left for further dividend increases. Because of the recent rally, Microsoft is by no means cheap anymore. Their current PE ratio is sitting at 33, which is quite a bit higher than this 19.5 sector median. The company is wildly profitable though, with a net income margin of 34%, which is much higher than the 2% average profit margin in the sector. And by the way, if you're wondering what site I'm using for all of the data in this video, it's Seeking Alpha, and with my link in the description, you can get a free 2-week trial on their platform, getting access to tons of features. And I, as a regular user of the platform, can say that I'm absolutely loving their product. The fourth company we'll be looking at is Lowe's Companies. Lowe's is a retail company specializing in home improvement and appliance products. It operates stores and an online platform offering a wide range of items for construction, renovation, gardening, and much more. Their products include building materials, tools, appliances, and outdoor equipment catering to both consumers and professionals. Lowe's aims to provide customers with what they need for various home products and is a prominent player in the home improvement industry. Similarly to many of the other companies in this video, Lowe's has also done well in 2023 so far. The stock is up by almost 13%, which is just slightly lower than the S&P 500, but over the past 5 years, Lowe's has significantly outperformed the indices, with the stock being up almost 132%. Lowe's has been an absolute dividend powerhouse for a very long time now. They currently offer a dividend yield of almost 2%, with 59 consecutive years of dividend growth, making them a dividend king. And in the past years, they have also been growing their dividends by quite a bit. The average growth rate in the past 5 years has been just under 20%, and even with these very nice hikes, the payout ratio is only 30%, leaving them with a lot of room for more potential dividend increases in the future. In terms of valuation, Lowe's is neither cheap nor expensive. With a PE of around 16, they are just a tad more expensive than other companies in the sector, but cheaper than the other home improvement giant Home Depot, which is a recurring trend we can see with the other valuation metrics as well, meaning that Lowe's is still somewhat attractively priced. Let's look at the last company on today's list, which is the craziest dividend grower in this video. The company that we're talking about is Evolution Gaming. Evolution Gaming is a Swedish company that provides live casino games with real dealers streamed online. Players can interact and play popular casino games like roulette, blackjack, and poker in a more immersive and authentic setting compared to traditional online games. They also innovate by introducing new and unique game variations, as well as incorporating interactive features to enhance player engagement. Overall, Evolution services have contributed to the growth and popularity of live dealer casino gaming in the online gambling industry, and you will most likely see their games on almost every online casino that exists currently. Since Evolution is not directly dealing with gamblers, means that they do not have to worry about authentication nor any issues surrounding overuse or fraud, the responsibilities for which lie with the operators themselves. The company is the pick and shovel approach to the online gambling industry that is projected to more than double in size over the upcoming 7 years. Evolution offers a starting yield of 1.9%, and year to date the stock is up by just over 9%. If we look at the price action long term, we can see that the stock has seen a massive gain of just over 650% over the past 5 years, which outperforms pretty much all of the major indices. As I mentioned in the beginning of this video, the dividend growth rate has been crazy on this one. They currently give you a yield of 1.9%, which is already solid, but on top of that, they have also been increasing their dividends by an average of almost 86% in the past 5 years. Keep in mind though that they currently have a payout ratio of just under 50%, which might mean you won't see these crazy dividend hikes anymore, but since they are growing their bottom line revenue by so much, you can still expect some market-beating dividend increases. And talking about growth, their revenue has increased from over $200 million in 2017 to just under $1.6 billion in 2022, meaning they have a 40% revenue CAGR in the past 5 years. Looking at their bottom line, their net income has grown from $50 million to over $600 million in 2022, meaning a 60% net income CAGR. As you may have noticed, they have a significant profit margin on their revenue, it being almost 58%. For this growth, you are currently paying a forward PE ratio of just 20, which considering the growth is an amazing valuation, even after it being up 55% from the 2022 lows. And that wraps it up for this video. I hope you all enjoyed watching and I hope to see you on the next one.